Let's get now to our market panel. Bespoke Investment Group co-founder Paul Hickey and Paulsen Perspectives author Jim Paulsen. Guys, welcome. Happy Monday. Jim, you say we got an everything rally going here. Why and what should investors do next?
Well, I think, this bull market's been the only one, John, that's lived under Fed tightening its entire existence. Only one, at least since post-war history. And I think what that's done is it's given us a bull, but with far less support than it normally has. Normally, when a bull starts, the Fed is dropping rates before the bull begins. And it was short rates going down, long rates come down, the money supply is going up generally, fiscal juice is expanding, normally because the Fed is worried about a recession or we're in a recession. Disinflation is helping as well. And finally, confidence starts to improve as the Fed eases because people start to feel a little better. Well, this time around, because the Fed has held rates up the whole time, short rates haven't come down, long rates haven't come down, money growth's been really rather weak overall. Confidence among consumers and businesses have been depressed. We've really only had disinflation and positive growth in the economy, and it's resulted in a narrow market advance, very narrow bull market just for a few parts of the market. Most of it hasn't even participated yet. The reason this is important easing is now that the Fed's dropping short rates, they're bringing the full support, making this feel more like the start of a new bull market. And everything bull. At the start of a bull, everything goes up, and we're starting to see that. We now have short rate stimulus, long rate stimulus, money growth's rising. Overall, disinflation is still in force. Fiscal juice is expanding. Confidence, I think, is going to improve. And what you're seeing is everything's going up. I looked at this over, John, and market's up about 10%. 6 of the 11 sectors are up 10% or more within the S&P. 10 and 11 are up 6% or more. 88% of the stocks in the S&P are up over that period of time, and 43% of them are up 10% or more. This is like the start of a new bull.
Okay, so Paul, market breadth also improving as all of that's happening. What message should we take from that?
Yeah, I think it rides on what Jim was talking about there. We've seen within the S&P 500, every sector's cumulative AD line has hit a new high in the last month, and 10 of 11 have hit a new high last week. So you go back to July 16th when the S&P last made its high, you had only 2 sectors outperforming the S&P 500 on a year-to-date basis. You now have 4, so we're expanding there too. There's a couple of others which are pretty close. But so what we're seeing there is we've seen the market essentially go nowhere in the last 2 months, but the average stock is up over 3%. There's 140 stocks in the S&P 500 are up double-digit percentages. So there's been a lot moving underneath the surface. And then when you look at the charts of the mega caps, 5 of the 6, besides Meta, are all pretty well off highs. So you've seen the baton passed from these mega cap stocks, which Jim was talking about earlier. It was a narrow rally to the broader market, and we're seeing this broadness. And it's just that, coupled with the fact that we've seen 2 pullbacks in the last 2 months, which were bought immediately. You tend to see sharp declines and then gradual rebounds. We've seen sharp declines and sharp rallies back, whereas the time to regain what was lost is almost as quick as the initial decline. And you don't tend to see V bottoms very often in sell-offs, but to see it twice in 2 months is pretty impressive, to say the least.
Okay, some good context there. Jim, we've had a flurry of Fed speak today. We're going to have more Fed officials commenting here as the week unfolds. And yet, Barron's writing, Fed uncertainty is history. Now markets need to brace for election volatility. Do you think that's the next key catalyst that the market will be reacting to?
I think there'll be some of that going on here in the next couple months. But I really think it's not going to be a primary driver. I mean, it's just hard to get that concerned about the election. When whoever wins, they'll probably have sort of a split power anyway. It's going to be such a close House and Senate overall, and we're dealing with the first easing of this cycle and so much other positive force coming at the stock market. I think that's going to overwhelm it. But I do think not so much that it'll bring it down, but I do think it'll reduce some volatility as we get close and the polls start to swing around and grab investors' attention.